This lesson is the second part of our lesson on calculating income tax from the taxable income, and it specifically applies to India in the years 2011-12 financial year. However, the general principles are applicable across all tax systems. Now, what we're going to be going over is the progressive tax table and then a graphic view of the progressive tax. Finally, we will talk about the features of the progressive tax. We will then talk about the flat tax, which is a specific version of the progressive tax, a graphic view of the flat tax, and finally its features. Now, the tax brackets, the progressive tax rates and brackets are shown for financial year 2011-12, as we've learned in the previous lesson. Now, essentially, the tax rate is 0 for between 0 and 180. Between 180 and 500,000 or 5 lakhs, it's 10%. 5 lakhs to 8 lakhs, it's 20%. 8 lakhs upwards, it's 30%. And again, this applies only to men below 65. The starred 180,000 changes to 190, 250, and 500 to 5 lakhs, depending on your age and sex. Now, I'll show you a graphic representation of the same thing. After all, we're trying to basically input the taxable income and we should be able to get the tax. That's the whole goal. Now, this whole thing could be explained simply by having a graph in which we show the taxable income over here, the taxable income shown in thousands, and on this axis we have the tax shown in thousands. Now, you'll notice that between 0 and 180, your taxable income, there is no tax. And that's why this line it remains at 0. Now, as we go between 180 and 500,000, this tax increases. And the slope of this line, in fact, is 10%, is the 10% we're talking about as the incremental tax rate. Once we get to 500,000, between 500,000 and 800,000, the tax rate goes up to 20%, the incremental tax rate. And that is shown in this graph by the fact that this line is a little steeper. The tax goes up faster here. And between 8 lakhs and above, above 8 lakhs, the tax rate is even steeper with a slope of 30%. Now, you'll notice that these incremental slopes, the slopes of the tax curve is basically made up of a set of straight lines, and these boundaries here between here and here, this is the 0 bracket. This is the first bracket, B1, between 180 and 500 or 5 lakhs. The second bracket is between 5 lakhs and 8 lakhs, and the third bracket is above 8 lakhs. The slopes of these lines are actually the incremental tax rates. Now, with this graph, for any particular taxable income, for example, in the first example we had taken in the previous lesson, it was at a taxable income of 8 lakhs 40,000. All we have to do is to follow on the taxable income on this axis, go to 8 lakhs 40,000, and then go up, get to the curve, which is actually 3 segments of a line, 4 segments of a line. We get here and then read off the tax on this axis, and this would be the 104,000. So actually this graph shows you the relationship between tax and taxable income. You'll notice it's a little more complicated than just a straight line relationship. It's not directly proportional. This curve gets steeper and steeper as we go along. Now, the average tax rate is actually the slope of the line connecting this point to this point. And you'll notice it's much less than the incremental tax rate that we are. You'll notice that even if you pay 8 lakhs 40,000, your actual average tax rate is only 12.5% of the 840 would you have to pay as tax. Now, we'll go on to the features of a progressive tax curve. I'll go back and forth between these slides. The tax on any taxable income can be found on the curve. There. All we have to do is to look up this taxable income here, go up, go up to that line and then find out the tax. The curve is a series of straight line segments corresponding to each bracket. Here we can see this is the first bracket from here to here. The second bracket is from here to here, and you notice it's exactly a straight line and the third bracket from here to here, and the fourth bracket is from here onwards. And you'll notice that the slopes of these lines are in fact the incremental tax rates, and the slopes are increasing in a progressive tax system. Now, another thing you'll notice is that the curve, even though it's made up of 4 straight lines, the curve is continuous. It doesn't have any sudden changes, in the sense that there's no sudden jumping from here. Suddenly, if the tax went up to this without any increase in income, that would be a jump, and that wouldn't be a proper progressive tax system. In a progressive tax system, there are several tax brackets. We've seen that, and the tax rate increases as we move from left, low income, to the right. The lowest bracket is usually exempt from tax, so its slope is 0. That's this portion of the curve, and this is usually called the 0 bracket. Almost every progressive tax system has that, because people who earn very little should really not have to bother about paying tax. The tax rate of the bracket that contains your taxable income is known as your incremental tax bracket. So if you had an income of 840, you'd go up here and say the slope of this line is 30%. So therefore, that's your incremental tax bracket, 30%. Your actual average tax is usually considerably lower than your incremental tax rate. In the example shown for the 8,40,000, the average tax rate is only 12.5%, whereas the incremental tax rate is 30%. Now, what this means is that if you're here at 840, you end up paying roughly 12.5%, which is the slope of this line, directly connecting 00 to 892, and that would tell you that the average is only 12.5%. The incremental rate is, on the other hand, is 30%. What that means is if you earn from 840, you suddenly earned 841, that is $1,000 more, you would then pay 30% of that 1,000 or 300 rupees extra in tax. So from 104, which it was here, you'd pay 104,300. Your incremental tax rate tells you what percentage of any increase you get goes to the government. For example, if you're in the 30% bracket, then 30% of any increase goes as extra tax. Now, remember that even in a progressive tax system, the residual income after paying tax is always higher the more you earn. You may have heard many people say that, there's no point earning anymore because all of it goes as tax. That's never true. As long as the incremental tax rate in the bracket is less than 100%, you always end up having more income after tax the more you earn. Okay. Now, the effects of cess on tax rates. The cess, remember, is a proportionate increase of the tax. It is currently 3%, the 2% plus 1%. So the incremental tax rates of 0, 10, 20 and 30 with the addition of the 3% cess become an effective incremental total tax rate of 0. That doesn't change. If you have no tax, there is no cess either. Now, the 10%, 3% of the 10% is 0.3. So that would get added on and you get 10.3%. The 20%, the cess would be 3% of the 20%, which is 0.6%. So it adds on to the 20% and you get 20.6 and 30.9. Okay, now what is a flat tax? A flat tax is a specific version of the progressive tax rates, where you in fact have only one tax bracket and therefore you only have one tax rate. That tax rate is called the incremental tax, is called the flat tax rate. And in this example, I've shown where the taxable income and the flat tax rate is 15%. So it's just straight away 15% of the taxable income. So if you earned 840, for example, you would then have roughly 15% of 840, which would be a lakh 100 and let's see, 15% of 840 would be 84, 42, 126, 126,000 rupees, or 1,26,000. Now, the features of a flat tax is the entire range of taxable income is considered as one bracket. Therefore, there's only one tax rate for the bracket. Naturally, the incremental tax rate and the average tax rate are identical. The tax is very simple to compute as a flat tax rate multiplied by the taxable income. The tax will increase as the taxable income increases. So the flat to flat tax refers to the rate which is constant across all incomes. It does not mean that the more you earn, that you always pay the same tax irrespective of what you earn. The flat tax rates are used as an example for company taxes in India, but not for personal income taxes. It is not used for personal taxation in India and in most countries because most people agree that richer people should pay proportionately higher taxes than poor people. Although a few people would dispute that and say that a flat tax is a fairer system. Thank you. I hope you understood.